So guys, please put your information in the chat, introduce yourself. But today we're going over common tax mistakes to avoid in 2025. So if you don't know too much about me, I'm a CPA here in Houston, Texas. We specialize in monthly accounting, tax compliance, tax planning, and much more. And I want to just briefly talk about some of the errors that we have been seeing over the past 8 years, basically filing tax returns. These are things that I talk to my clients about. They come to my office and discuss, and that we commonly see while filing the tax returns and what people are confused about. All right, so that's what I wanted to do this webinar about. And mainly what I want to discuss is the common tax mistakes. And I know y'all guys see a laundry list of filing late, overlooking, all that. The main one I really want to point emphasis to is poor record keeping. This is by far the largest mistake I usually see. And I use the word largest is because of this mistakes, it usually creates the largest tax liability, and it's poor record keeping. I was surprised heading into the business how many million-dollar companies not doing record keeping, no books, no nothing. So mainly what I'm seeing is poor record keeping from our business owners. It's the fact that they don't have any true accounting system. And if they do have an accounting system, it's not right. For example, most of our clients, sometimes if they're in the million, we truly deal with business owners that make $1 million plus. They can have $1 million business, and they have their accounting, they have some bookkeeper, maybe from QuickBooks, but on their books, they have loans, right? Usually they have some type of tax loans that they took out for SBA or whatever it may be. You commonly don't see the interest expense being moved over from that loan over to the profit and loss. This can result in basically that taxpayer overpaying in taxes because technically they're missing expense. What the bookkeeper does, they take that whole principle and they just apply it straight to that loan, not realizing that some of that money that they paid, and sometimes in most cases, majority of that money was interest expense. And only the principal balance should hit the loan and the interest expense should hit the books. Most people don't understand that. So in the result, a client could have like $100,000 profit, and they could have probably $80,000 missing in interest expense that they need to account for. This will basically cause a client to overpay in taxes. That's poor record keeping. Mainly because the bookkeeper they don't even have some type of accounting system. They're not factoring in their interest expense. And that's one of many cases. Right? So that's by far and that's just one example, but that's one of the largest mistakes that I see when it comes to filing taxes is poor record keeping. You should be worried if you're heading into tax filing time and you just hand your CPA some bank statements. That means they have to do a year's worth of financial and compiling to come up with some type of record keeping so we can use that to file somewhat accurate tax returns. So to be honest, that's the main takeaway. If we can just stop the video right there, it would be about poor record keeping. Some of the other ones that kind of tie into poor record keeping is overlooking eligible deductions. You'll be surprised how many business owners they have these business vehicles. They didn't track mileage, or they have some type of home office, and it's not accounted for in their tax return. Mainly because the tax preparer doesn't know how to file it, or don't know what form to put it on, or don't have the proper experience, or in some cases, a business owner can be filing their taxes themselves through TurboTax. This is a huge mistake. There's a story, I won't say his full name, but we had a client who's in let's say the marketing industry. He basically didn't have any type of accounting system. He was basically overlooking eligible deductions and having poor record keeping. We found over $600,000 worth of expenses that he can basically bring into his business. We found over $600,000 worth of expenses that was accounted for his business. If he didn't do that, that means his profit was going to be overstated. He knew how to basically market, didn't know how to run a overall operations business when it comes to your back end office. This extra money that we saved him, basically he can use that to hire, build better systems, or whatever he wants to do, a trip to Jamaica for all we care. We just know that it's not all going into the IRS pockets. And that those are hand and those go hand in hand. Overlooking eligible deductions and doing poor record keeping, those kind of go hands in hand. Another thing, and I'm not I want to talk about the main things, right? But another thing is basically ignoring estimated tax payments. Those lead to fines. It leads to you paying penalties. And most people don't know, when you start owing taxes, the following year, they want you to start making your estimate tax payments on the tax return that you basically filed that you owed on. So for example, if you owed in 2023 tax return, in 2024 during the year, you need to be making quarterly estimate tax payments. The IRS requires you to do that. So you should be getting a 1040-ES for each payment, right, is needed. So those are some of the common mistakes that I see. And, we can basically just stop the video right there, because you'll be amazed how many people just don't have record keeping, don't know the need for it. They just don't do it, right? So the next part I want to talk about is just some of the IRS red flags for audits. And before I talk about audits, one of the biggest ways to lose an audit is not having record keeping. Notice I keep saying that. Record keeping. We need it. It's the root of everything when it comes to running a business. So back to the red flags for an audit. Inconsistent income reporting, right? This is what I had majority last year. I think we had 10 cases with realtors. Their 1099s, what their agency reported for them, didn't match what was on their tax return. It either was a lower number or it just wasn't on there. One of the red flags, and it's not even like a human's checking for this. This is an automated system that it goes through. The IRS is going to flag that, and they're going to keep sending you letters saying, hey, we found discrepancies in your tax return. We think you should owe this much. And it's going to be a higher amount, and they're not going to basically factor in any deductions from that 1099 income, although you probably have some deductions related to that 1099 income. So one of the ways to kind of like not be inconsistent with your income reporting is checking your wage and income transcript. Each year, say if you don't have your records, or you misplaced your 1099, or you can't hear back from the person, likewise with your W-2, you can look at your wage and income transcript. That's where it should be reported. If it's not reported there, that means your employer did not basically file those W-2s and 1099s for you. That's an error on their end. But that's one of the most common ways. And, mind you, this is an automated system checking for this. So they see basically like, oh, taxpayer filed their tax return, and we don't see a 1099 on there. There's going to be some type of discrepancy, and that's when the letters are going to start to come in. You'll be surprised how many people filed their taxes. The husband forgot to put their 1099 on there, and now they're getting letters that they owe $20,000. In most cases, sometimes they don't know what to do, so they just pay it, or they get on some type of installment plan, and everyone's confused. All right, excessive deductions. It may trigger an audit. My biggest thing is, and I always say this with a grain of salt, you can write off everything, but you can't defend everything on an audit. Be careful what you're deducting. You better have record proof of it, either through your bank statements, receipts, or photographic proof of it being reasonable and necessary for your business, so you can run your company, right? So that's just something to do. That's something to factor in. And those are, I want to say, like kind of like the top two right there. Yeah, you have home office. It may, raise up the audit level, but those are easy to defend in most cases, excuse me. So I don't really want to cover those too much, but those I'm hitting the high levels of the red flags that may come about, right? One thing, and here's what we need to do to kind of go about compliance strategies, right? One thing to kind of solve all these issues: file on time. Please remember that business tax returns are usually due a month before your personal. Use a professional, use some type of tax software. I'm dealing with a case right now that the business owner wanted to take filing taxes in their own hand. It came out to be their refund is now frozen. Use a tax professional that has a tax software so we can do this the right way and kind of forget about it. Yeah, some of their costs may be high, but it's going to help you on the back end. It's just going to help you remain compliant. Your biggest thing that you need to do is make sure you have accurate records. Not a desk full of receipts or whatnot. This isn't 1993. We need to have accurate records through some type of accounting system. You want to be able to have a profit and loss and balance sheet and just send it to your tax preparer so you can just be the first in line and kind of get filed quickly so you can either know how much you're going to owe or see your refund, depending on your tax case. Right? That's by far the most important thing you need to do. And I want to show y'all guys how to basically have accurate records. Right. So if you're a business owner making, over 750 plus revenue and you don't have an accounting system, you need to be calling folks like myself. You need to have your monthly accounting set up. You need to have a team behind you, and you need to stay compliant, not just with the federal, but also with the state in which you do business. Right. So that's actually the biggest way to kind of save, and the most appropriate way to start the tax planning is having an accurate financial statement. Without it, don't even worry about tax plan, because you don't have the accurate data to even see to give the direction of a CPA on what tax plan needs to be done. That's why the first step is always having accurate records. So yeah, I wanted to do this quick webinar just to kind of go over some of the things that I'm seeing within the industry and kind of, tell y'all guys the route on what we need to do. And that's mainly have your accurate records, get some type of QuickBooks. If you're a business making over 5 million, look into a more tailored accounting system. Maybe it's NetSuite or Sage Intacct. Take a look at those, but we need some type of accounting system. That helps us with everything we need to do. Whether it's you want more cost accounting so you can actually look at profit margins within your business to see if you need to do price increases. You want more of a detailed strategy on how to do your certain tax plan, just so you're saving money in taxes. You want to know how much to pay yourself. All that comes from basically having good, healthy books and a great CPA that knows the tax law. No, there's no way to make this sound cute or make this to sound more interesting. Though it comes down to that. Once you have those two, you will create a roadmap on what needs to be done, as far as what solution you're needing in order to get it resolved, and we can go from there. All right. So I just want to do this quick webinar and say thank you. If you have any questions, let us know. We work with companies mainly within the insurance agency, government contractors, real estate professionals, and then also other professional services such as medical professionals and also attorneys. Those are bulk of our clients. With leading in actually government contracting. But if you need help with basically just having a CPA under your team, we may be the firm for you. For example, we have clients where there's 4 people on their account from our firm. It's me being the CPA. It's maybe someone else as the account lead, that face of the account. And then they have their own set of bookkeepers that's under our firm. And then they have admin support too as well. That's 4 people on your account looking for ways to either do a tax plan, make sure you're compliant, and make sure your business is organized. Right. So we need to be more diligent with making sure we have the right accountant underneath your team. And I know our team would be a great fit, but it's just something to look at, guys. Let me know if you have any questions. That's my number there. You can always reach us at the email to schedule a call. Happy to work with you.